Hi, and a very good evening. Uh, my name is CJ. I'm the head of sales over at GSR. Today's topic that I'm going to be covering on this webinar is with regards to liquidity provision in an ecosystem. Now, as it stands, liquidity provision is not the most exciting thing, but it is one of the most necessary things available. So before I go into the actual presentation and talk about liquidity provision as a whole, I'd like to introduce GSR and who we are. GSR is one of the oldest market makers on the street. We were founded in 2013. Right now, we have close to 300 people globally across the globe. We have a very large venture arm where we've committed more than $100 million worth of capital. More importantly, though, we work with close to 200 projects across the street when it comes to market making. Besides market making, we're also involved very heavily in OTC trading for both spot and derivatives with solutions for our clients. So moving on to the topic for today and protocol liquidity and liquidity provision in general. It's very unique within crypto and it's very unique to crypto. Using Tesla as a comparison, if, for instance, within a stock market where Tesla trades, liquidity slows down, the bid offer widens completely, Tesla will still function as a company. It's just the investors who end up losing out. However, when it comes to crypto and the currencies behind it, imagine and picture the base layer, layer one liquidity. If there is no proper liquidity provision within that base layer, it starts to affect all of the dApps which are built upon it. This affecting of dApps means there is a slowdown, they can't function properly. Now, with regards to the dApps themselves, imagine apps and the tokens they issue. If there is no proper liquidity provision, if there is no ability for people to come in, trade, buy, and sell the underlying tokens, be it whatever use case there were, this then affects end users within the ecosystem. If we think about where crypto stands at the end of the day, it's all about the ecosystem and its users. So this is where protocol liquidity becomes a very, very important part of it. So on the basis of this, let's move into where market makers sit in this whole thing. Market making itself is a very unique proposition. In traditional finance markets, market makers tend to congregate and coagulate towards centralized venues. For instance, if you were to trade a singular stock, all of the venues, all of the banks, all of the financial institutions will trade upon these singular venues. It becomes very clean. However, in crypto, this is a very unique, different proposition. What we see within crypto is the fact that liquidity pools tend to be very decentralized. They're spread out across different exchanges, across different DEXs, and within the OTC markets themselves. This is where a market maker comes into play. The job of a market maker is to ensure that trading of the underlying token becomes synonymous. It becomes the same regardless of where you trade. The aim of a market maker is to ensure that when people trade, they have the best experience possible. When we talk about experience when it comes to trading, there's a few things. One is the concept of slippage. When we talk about slippage, what we're talking about is the ability to buy a token in a certain amount without moving the market a certain percentage points. Now, obviously speaking, if a guy comes in with a large enough order, it will eventually move the market. However, looking at where proper books come into play, this creates confidence in a project. It creates confidence for people to trade. Most market makers on the street, GSR included, focus on centralized venues. The reason why is this is where most people and most retail markets and consumers within cryptocurrencies are comfortable in trading. They're able to see order books, they're able to see order sizes, and based on that, it's easier for them to trade. There is another element where liquidity is provided for, and that's within OTC markets, be it in block trades, be it in larger ticket sizes, and that is done on a more bilateral basis between the end users and the liquidity providers. DEXs have made a very important move and leap forward in the recent year, and we see more and more individuals trading on a DEX. DEXs themselves have improved tremendously. We've seen it with where Uniswap V2 went to V3, and we continue to see evolution and development on that basis. So when it comes to a market maker, what is the market maker's main job? A lot of projects misunderstand where a market maker fits in the ecosystem. When they go to a market maker, a lot of projects and layer one solutions tend to look at market makers as people who can help them with regards to factors like price support and volume creation. This is actually the wrong aspect to look at, and this is something that projects should never wish for. Reason being, and just to walk you through the two differences on this one, when it comes to price support, for instance, imagine you tell your market maker to defend a certain price, and imagine the whole market is collapsing around it. It's happened over the last couple of weeks. It happened last year towards the end of Q4. By defending that price, it's artificial. What it also means is that the market maker eventually will have to reverse this trade because they're actually taking losses defending this price. When they reverse the trade, sometimes it can be quite violent. It can be at the most inopportune moments, and this will greatly affect the project because it greatly affects the underlying community. The next part, which is something that we get asked a lot of, and there's a lot of discussions around, is the concept of wash trading, creating fake volumes. This actually is more hurtful than people realize. At the end of the day, a lot of projects say that it's fine because in their mind, what they end up seeing is see great 24-hour volumes, right? But what they don't realize is the after effects something like this can come about from. To give you an example, imagine if the organic volume of a project sits at $1 million a day. This is real volume trading across the different venues. Now imagine someone comes in and starts churning this, washing this volume, and this volume goes up to say $5 to $10 million a day. The problem is that organic volume is still at $1 million. Now imagine if a whale comes in, and in crypto, whales are very, very common. If a whale comes in and suddenly says, oh, I see $5 to $10 million, I'm going to put in a sell order for $2 million. Theoretically speaking, it should be able to accomplish that within the market. But because there is no real volume at the $5 to $10 million mark, what ends up happening is the whale ends up slamming the market. And this ends up pushing the market down. So at the end of the day, what should a good market maker do? And how should they look at the provision of liquidity? So when it comes to market making, a market maker should focus on three things. The first is spreads. When we talk about spreads, what we're talking about is the bid offer. How easy is it, the differential, the space between the ability to buy and the ability to sell a token? The tighter it is, the better it is, because this refers to a cost to the underlying person who's buying and selling. The wider the spreads are, the worse it is for the project, the worse the experience is. For a lot of projects, you can always tell when they don't have a market maker because their spreads tend to be 2, 3, 4, even 5% out. So spreads play a very important role. The next part is size and depth. When we talk about size and depth, we're talking about how thick the books are, a certain percentage away from the middle price that you see in the market. This is very important because this dictates how much size can be traded and how much size is available to prevent maximum slippage. To give you an example, let's assume that there is a book 2% out, we're saying $15,000. What it means is that you can trade up to $15,000. But imagine if you traded more than that. How much would it move the market? Now, imagine if you didn't have proper book depth. There was nothing there. You could easily put in a $1,000 order and it can move the market multiple percentage points. The way to look at market making is a good market maker creates what we call the butterfly of the books. Equal both sides. And this butterfly of books is almost like having a foundation of a house. It's like building a house. Imagine when you build a house, you put structural support in, and these such structural support in market making refer to the different layers of the order book. Then what happens is the ecosystem comes into trade. So users will come into trade, and these users who come in fill up the rest of the order book. Back to the house analogy, what that allows them to do is they fill in the walls, they fill in the rooms, they fill in the door. They, in essence, create and build the house. The last part, which is actually extremely important for a market maker, and is honestly the true test of how good a market maker can be, is the order book presence. Everything is really easy to say when the entire market is green and everybody's happy and everybody's celebrating. But the key then becomes, what if the market starts turning, which it has done multiple times in the last couple of months? It's key for a market maker to remain on the books. The reason why is, yes, the price may still fall if it's a negative based market, but by having a market maker present with regards to when it's falling, it helps soften the blow. That's what you want. You want a market maker to have multiple layers in a book. As the prices come in and selling starts, they start refilling the levels so that the slide down is controlled. Order book presence becomes very, very important, with most projects requiring at least 95% and above. On an average on our side, we're probably 98 to 99% there. The other important things, and this is more not related directly to the market making portion, but with regards to the communication between a market maker and its client. It's once again a very unique situation. Most projects, when you talk to founders, the founders themselves are brilliant technically. They are the geniuses, they're the innovators. But market making, if you think about it, is a pure aspect of capital markets. And this is where we come in. This is where we come in to educate, to guide, and to walk them through the entire process. Communication becomes key. Not only is communication in the form of being able to reach your market maker as and when times of the days, as and when you need them to ask a question, but also in terms of what information are you able to glean from a market maker about their market making. On our side at GSR, how we do it is we communicate this to our clients via daily, weekly, and monthly reports. What these reports do is they tend to tell you the average prices, the highs and the lows, but more importantly, they tend to tell you what the market maker's share of a book is relative to the entire market, as well as your uptime. Now, this is an interesting aspect when it comes to market share. A lot of clients back in the day, they would love it. Whenever they see the numbers of, oh, your market maker's market share is 70, 80%, they tend to think it's really happy because they think the market maker is doing their job. What they don't realize is that when it comes to market share, the sweet spot tends to be the 10 to 20% range. The reason why is at the end of the day, once again, we go back to the original analogy of building a house. Our market maker's job is to fill in the structural aspects. It is up to the ecosystem to fill in the rest. If your market maker becomes a very high percentage of your market share, what it means is that your ecosystem is only trading with your market maker. They're not trading amongst themselves. The project, when it comes to token economics and the ecosystem itself, needs to encourage velocity of tokens. It needs to encourage movement of tokens. Utility, so to speak, is what a common term that we use. So what you'd expect is the market share should be lower. Now, at the end of the day, some projects come about it and they ask, why do I need a market maker? If it's trading well. Once again, we move back to the fact that in green markets and stable markets, it's fine. But when markets start getting scared and volatile, the books tend to swing one way. And that's the problem. By having a market maker, it prevents this situation from exacerbating itself. It keeps it a lot more on a stable basis. And yes, the price will fall, but it will fall in a much more controlled element at the end of the day. Besides market making, another aspect of where GSR comes into the fray is we handle a lot of capital preservation. We work with our clients on the foundations, the early investors, when it comes to treasury management, as well as generating yield. We also guide our client as to the right practice within market making, as well as to grow the ecosystem. Once again, referring to it, when it comes to the market making side of the business, it's something that takes years to perfect, in all honesty. Not only that, a market maker should be a strategic partner for a project. And when we say strategic partner, what we mean is it's somebody who can be the adult in the room. Capital markets are a very scary aspect of the business. It's an area of the business that many projects don't really look into. And what happens is when they're token list, what they do, they tend to do what we call price watch. Every day they just look at where their token price performs. The project's job is to focus on building your product. It is to focus on building your ecosystem. The market maker's job is to have your back, to ensure that from a capital markets perspective, your ecosystem can trade the token when the time comes for it. That brings me to the end of what I have for this webinar. I hope it's been informative. And should there be any questions, please feel free to reach out. Thank you.